Welcome to the deep dive, where we cut through the noise and really get straight to the insights you need to be truly well informed. Today, we're setting the stage for something, well, pretty profound, I think. Have you ever wondered why financial crises seem to just keep happening? Or why big societal shifts sometimes feel, I don't know, weirdly familiar? It's almost like there's some kind of hidden blueprint, you know?
Yeah.
A master template playing out, shaping our world economy.
It really does feel that way sometimes, and that's exactly what we're going to try and unpack today. Our mission really is to take a proper deep dive into Ray Dalio's big debt cycle framework. He lays it all out in his book, How Countries Go Broke. And look, this isn't just about understanding money and debt in isolation. It's about seeing how these forces, plus, basic human nature, combine to create these really powerful, predictable cycles. We'll also explore how these cycles connect with four other equally big forces that are shaping things right now and, well, into the future. Think of this as your shortcut to understanding the deeper stuff, the mechanics behind the daily headlines.
Right. Ray Dalio calls this the big debt cycle, and he emphasizes it's timeless and universally consistent, which is quite a claim. But here's the bit I find really interesting. He says it only happens about once in a lifetime, which apparently makes it generally not well understood. So what makes it so different? What is this thing at its core?
Well, at its heart, it's driven by the pretty natural mechanics of how money, credit, debt, and just general economic activity work, and crucially, how that's all tied up with human nature. Fear, greed, the usual suspects. Dalio tries to simplify the whole economic system, breaks it down into five main parts to make it easier to grasp. You've got goods, services, and investment assets, basically, the stuff we buy and sell. Then there's money itself, obviously. Next, credit, which lets people buy more stuff now, and that credit creates debt liabilities for whoever borrowed it. But on the flip side, that liability is someone else's debt asset, like a bond or maybe just money in the bank. Understanding how these five things flow and interact, that's really the key to getting these cycles.
So it's not just a snapshot, it's the flow, the interaction. It almost sounds like a living thing, doesn't it? And Dalio has this fundamental equation for prices. Price equals total amount spent divided by total quantity sold. What's the big insight there for us?
Yeah, the key insight, and it's a big one, is his point that these cycles are driven more by the creation of money and credit, basically the total dollars being spent, rather than just changes in the quantity of goods or services being sold. So the big takeaway, it's the flow of money and credit, the liquidity, that really drives price changes more than the actual volume of stuff changing hands.
Okay, so the amount of money sloshing around is key. But how does this huge once-in-a-lifetime cycle actually begin? It must start pretty subtly, right?
Oh, absolutely. It really does. Like any big story, it starts quite innocently. In the early stage, borrowing is easy. Dalio says it's easy to borrow, even to borrow a lot and pay it back. You mostly see these short-term debt cycles playing out, driven by incentives. But there's often this lingering caution from maybe the last time money was tight. Debts and the cost of servicing them are pretty low compared to incomes. It all seems quite manageable, quite sustainable.
Seems okay. But then we hit the debt bubble stage. This is where things start sounding, well, bubbly. Tell us about that phase.
Right. This is where the trouble starts brewing. Money becomes, quote, readily available and cheap. And that fuels a debt finance economic expansion and an economic boom. Demand and prices for almost everything, goods, services, investment assets, they all get pushed up by people borrowing money to buy things. Sentiment gets very bullish, everyone's optimistic, and, by most conventional measures, the market is overpriced.
You mentioned it fuels a boom, it sounds great, like a party, but Dalio also mentions amazing new inventions playing a kind of deceptive role here. How do these innovations, which sound so good, actually contribute to the bubble?
Yeah, that's a really sharp point. Investors and people generally get swept up in the excitement of genuinely transformative innovations. Think AI today, maybe. They pour money into them, but often without properly assessing, the future cash flows. Will it actually make enough money down the line to justify the price? And this stage often features what Dalio calls a current most popular meme, an idea that just about everyone believes. He points out these big popular beliefs are often bound to be wrong in some way, usually because people just extrapolate past trends, get emotional, and completely ignore basic asset pricing, the core idea. When everyone agrees on something, especially in a market, well, that's often a warning sign.
And he has that great line about wealth is created out of nothing during this stage. What's he getting at with greater imagined wealth versus actual existing wealth?
He uses a really specific example. A unicorn company, valued at over $1 billion. On paper, the founder might look like a billionaire. but maybe the company only actually raised, say, $50 million in capital. The huge valuation comes from speculative VCs, putting in money for what he calls option-like chips, just hoping for a massive payoff if it takes off. The point is, this imagined wealth, it's not tied to real immediate income. And that dynamic inevitably produces a bubble. The debt needed to finance all this speculation starts growing faster than the actual income needed to pay it back. It's like building a skyscraper on shaky foundations.
A house of cards, basically.
Yeah.
And this leads inevitably to a point of no return. That sounds ominous.
It is, yeah. The debt spiral reaches and goes beyond, the point where it can be fixed without causing great losses to debt investors. This is what triggers a self-reinforcing death spiral. Because as the risks become obvious, interest rates have to start rising to compensate investors. And those rising rates make the debt even harder to handle. That's when a real debt crisis can kick off, often much faster than people expect.
Wow. Yeah, that sounds like it could unravel very quickly. Which brings us, I guess, to the next stage, the deleveraging stage. How does that painful process unfold?
Yeah, deleveraging. Dalio describes it as a painful bringing down of debt and debt service levels to be in line with income levels so that the debt levels are sustainable. Basically, getting back to reality. Typically, the debt problems start in the private sector, maybe with mortgages or companies. Then they spread to the central government and eventually land on the central bank's doorstep. A big red flag, Dalio says to watch for, is net selling of debt assets, especially net selling of government debt assets. People trying to get out. This can show up as runs on banks as the problems become clear. People want actual cash, not promises, and the lenders just don't have enough on hand. The core insight here is really about trust. When trust in the system breaks down, the whole financial machine can just seize up.
Okay, so the system seizes up. What happens to all that debt? How does it actually get reduced?
It gets reduced through a combination of things, none of them pleasant. Defaults, restructurings, and/or devaluations. This requires what Dalio calls an aggressive mix of debt restructurings and debt monetizations. Now, he does talk about the concept of a beautiful deleveraging. Sounds nice, right? This is where the government and central bank work together. They do debt restructurings, which cut the debt burden that's deflationary, but at the same time, they do monetary stimulation, providing money and credit, which is inflationary and helps the economy. The goal is to balance these opposing forces to get positive growth with falling debt burdens and acceptable inflation. He likens it to trying to land a jumbo jet smoothly without crashing. It's incredibly difficult.
You mentioned central banks stimulating printing money, but Dalio clarifies they don't literally print banknotes, do they? What are they actually doing?
That's right, yeah. It's a shorthand. They don't run the printing presses necessarily. What they do is create digital money, essentially, and use it to buy assets, usually government bonds from commercial banks. This injects reserves into the banking system, pushes down interest rates, makes credit easier. But there's a danger, especially if they do too much. It can lead to that self-reinforcing spiral we talked about. Imagine the central bank earns less interest on the bonds it bought than it pays on the money it effectively borrowed to buy them. It starts making losses. To cover the losses, it might have to create more money, maybe buy more debt, which leads to bigger losses. That's the death spiral again. Done in large amounts, this process devalues the money and creates inflationary recessions or depressions. The key takeaway is even central banks aren't magic. They can push things too far.
Fascinating. So this painful deleveraging, whether it's beautiful or just plain ugly, it eventually establishes the bottom. It's like hitting reset so the next big debt cycle can begin. And Dalio also has this interesting take on debt and currency being essentially the same thing. Can you unpack that a bit?
Yeah, it's a powerful idea. He argues that because a debt asset like a bond is just a promise to receive a certain amount of currency later on, then debt and currency are essentially the same thing. His point is, if you don't trust one, say, you think the government might default on its debt, you probably won't trust the currency itself much either, especially when you factor in yields and expected price changes. The big insight is that trust in a nation's currency is fundamentally linked to trust in its ability to manage its debts. They stand or fall together.
Let's zoom out a bit then. Dalio also talks about a short-term debt cycle, the one that happens more frequently, maybe every 6 years or so. How does that work, and how does it connect to the big one?
Right. The short-term cycle is the more familiar one. It involves recessions, then central banks cutting rates and making credit cheap to stimulate things. That leads to booms, sometimes little bubbles. Then the central bankers get worried about inflation and tighten credit again, which of course weakens markets and the economy, potentially causing the next downturn. Rinse and repeat. The crucial link to the big debt cycle is that each short-term cycle typically ends with higher levels of debt than the previous cycle. Policymakers tend to cut rates aggressively to end recessions, encouraging more borrowing. So with each mini-cycle, the overall debt level creeps higher and higher, like adding floors to a building, eventually setting the stage for that huge, long-term, big debt cycle correction. The insight is, we're constantly, in these smaller ways, building up the conditions for the next really big one.
And he uses that fantastic analogy for unsustainable debt, plaque building up in the arteries. That really paints a picture.
It's a great visual, isn't it? When debt grows faster than income, it reduces the amount of income flow that can be used for spending or saving. Because more and more of your income is just going to serve as the debt-paying interest, basically. If that flow of money gets too restricted, too squeezed, you eventually get a default, which is the economic equivalent to a heart attack. The insight is that debt isn't just some abstract number on a balance sheet. It's a real strain on the vital flow of money through the economy, just like plaque is a strain on your body.
So how do we spot these risks building up? What are Dalio's main warning signs?
Well, he looks at a lot of things, obviously, but he highlights 4 main indicators related to debts relative to income. He stresses that debt to income is actually more revealing about a debtor's ability to service their debt than the more commonly quoted debt to GDP ratio. Let's take the U.S. government example he gives. As of March 2025, it's like a household spending $112 for every $100 they earn, and that's before paying any interest on their credit cards or mortgage. That's a 12% primary deficit right there. Now, add to that, they're borrowing another 20% of their income just to cover the interest payments on their existing debt. Dalio calculates this means the U.S. government's total debt is about 580% of its income. I mean, imagine owing nearly 6 times your annual salary and the projections. He says it's heading towards maybe 700%, perhaps 650% over the next decade. And logically, if your debt goes up that much, your interest payments are going to go up proportionally too. You can see how that plaque builds up fast.
Wow, that household analogy really brings it home. And this feeds right back into that self-reinforcing death spiral he mentioned. How quickly can that escalate?
It can happen surprisingly fast. It's a vicious feedback loop. Rising interest rates leading to worsening credit risk, which then leads to less demand for the debt because who wants to buy something risky? Which in turn forces interest rates even higher to attract buyers. And round it goes. This can rapidly make a government's financial situation much, much worse. The insight is that market perception, once it turns negative, can transform a manageable situation into an unmanageable crisis almost overnight.
And the central bank's role in all this, they can step in and monetize the debt, buy it up, but that has its own serious downsides, right?
Absolutely. The central bank does have the power to create money and buy or monetize government debt to try and keep interest rates down where they want them. But, Dalio points out, the newly created money doesn't just stay neatly within the domestic economy. It can directly flow out of the currency, creating a selling pressure on the currency itself in global markets. So while monetization might seem like a fix for high borrowing costs, the big risk is that it can devalue the currency, hurting the purchasing power of everyone who holds it. It's a really tricky balancing act with potentially severe consequences.
We've spent a lot of time dissecting this big debt cycle, and it's clearly incredibly powerful on its own. But Dalio takes it further. He reveals it's actually just one part of a much bigger picture. He calls it an overall big cycle, driven by the interaction of 5 major forces happening at the same time. And he says this overall cycle is, quote, by and large, unfolding in the classic ways that will produce dramatic changes. So let's pull back the curtain on these 5 forces. First up is the internal order and disorder cycle. This is basically politics within countries, right?
It's exactly. Internal politics, social cohesion, that sort of thing. This cycle is typically characterized by large gaps in wealth and values. Think inequality and polarization. Also, bad and worsening conditions for significant parts of the population, and often weak, fragmented leadership, especially in democracies. Dalio observes that in these conditions, compromise breaks down. You get these intensifying populist conflicts, maybe hard right versus hard left, with a weak middle squeezed out. And historically, this internal conflict can eventually lead to the eventual replacement of democracy with a more centralized dictatorial form of government. The key insight is that deep internal divisions really weaken a society, making it vulnerable to quite radical shifts in how it's governed.
And he brings up the figure of the demagogue in this context. What role does that kind of leader play?
Yes, the demagogue. Dalio describes this as a leader who manipulates public opinion, stirs up emotions, and uses extraordinary means to gain power. often bypassing traditional norms and institutions. These leaders frequently make radical changes to the monetary, political, and geopolitical orders. They tend to become nationalistic, militaristic, expansionist, and autocratic, end quote. What Dalio notes looking around today is that this is now taking place with big political shifts, mostly toward the hard right, for the same reasons that they happened in the past. He specifically highlights that in the U.S., the political parties are now more extreme and their divergence has become larger than ever before. The implication is pretty clear. We seem to be seeing these historical patterns of internal conflict and the rise of certain types of leaders playing out again right now.
Okay, force number 2 is the external order and disorder cycle, geopolitics. How did the post-World War II order look, and how is that changing according to Dalio?
Well, after World War II, the United States emerged as the dominant power, the world's richest and largest creditor nation. And the U.S. dollar became the dominant reserve currency, a position Dalio says the U.S. eventually abused. Looking at specific relationships, take China and the U.S. They went from being enemies to sort of friends or at least collaborators in the 60s and 70s, remember the Nixon-Kissinger visits. But now, starting really around the Trump and Xi administrations, we're back to what Dalio calls great power conflict. It's evolved into a type of Cold War involving diplomatic, cyber, and trade wars.
And the view from China is critical here too, isn't it? They see things very differently.
Very differently, yes. From the Chinese perspective, as Dalio outlines it, the U.S. is often seen as a hegemon trying to control the world order, trying to keep China down. Now, a critical insight from Dalio here is that while he doesn't actually expect a hot military war between the U.S. and China in the near future, mainly because of mutually assured destruction, nuclear weapons basically pine count, he warns that the most important and threatening stuff is going on in secret. Cyber warfare, intelligence battles, tech competition. That makes the situation inherently dangerous, even without open conflict. He also notes the fading into irrelevance of multilateral institutions like the UN or WTO and the rise of unilateralism, where it's more about the strong prey on the weak. The big picture takeaway is that the global power structure is shifting dramatically, and the old rules just don't seem to apply anymore.
The third force is acts of nature. This one feels different, maybe less predictable, but Dalio argues it's historically been a huge factor.
Huge, yes. It often gets sidelined in economic discussions, but he emphasizes that historically, acts of nature have killed more people than wars and toppled more orders than all the other four forces combined. Think pandemics, famines, floods. And looking forward, his expectation is that these kinds of events will increase in frequency and be very costly. Climate change is a big driver here, obviously. What's really concerning, he points out, is that very little is going to proactively prevent and prepare for the high costs, largely because the world is already so heavily indebted. There's just not much fiscal room. These costs include things like extreme heat, droughts, floods, rising sea levels, new health problems. The impact is often worst in the global south, which can lead to more domestic conflict and emigration, putting strain on other countries too. The powerful insight is simply that nature remains this massive, often overwhelming force, and our current financial state makes us particularly vulnerable.
Okay, and then the fourth force, human inventiveness, particularly new technologies. This sounds like the positive one, the hopeful one.
It certainly has huge positive potential, yes. Technology has always been a driver of rising living standards, creating economic and military power. And yes, unfortunately, it's also always been used in wars. Dalio specifically points to the great advances in technology, particularly in artificial intelligence that we're seeing right now. He actually estimates that the positive impacts from AI could be something like about 150% of what happened over the last 30 years in terms of technological progress. He thinks it's potentially the most powerful ever.
Wow, 150%. That's a massive impact, a real game changer. But knowing Dalio, I suspect there's a but coming. Is there a big caveat here?
There is, and it's a crucial one. His big caveat is that this positive force will not be enough to negate the headwinds of debt, internal conflict, external conflict, climate change, and demographics, if those other forces are not managed well. The core insight here is really profound. Technology, no matter how amazing, can't solve our fundamental human and societal problems, debt, conflict, environmental damage, if we don't actively manage those issues ourselves. AI won't magically fix bad politics or unsustainable debt.
Right. Technology is a tool, not a silver bullet. Okay, let's make this more concrete. How have these cycles actually played out in recent history? Let's start with the U.S. experience, say, from 1971 onwards. Dalio flags August 1971 as really pivotal. Why then?
Yes, August 71, That's when President Nixon effectively ended what Dalio calls MP0 monetary policy phase 0. That was the old system where the dollar was linked to gold, the Bretton Woods system. Nixon transitioned the world to MP1, which is basically the fiat monetary system we have now. Central banks manage money and credit mainly by adjusting interest rates and reserve requirements, and crucially, they're not restrained by the link to hard currency like gold. It was a fundamental shift, essentially cutting money loose from any physical anchor.
And that move led directly into a period I think many of us remember or had heard about, stagflation through the 70s, lasting until about 1982. Can you paint a picture of what that felt like economically?
Oh yeah, stagflation. High inflation and stagnant growth. It was a tough time. During that decade or so, the Federal Reserve let the money supply grow rapidly. M2, a broad measure, went up about 180%. Consumer prices, the CPI, shot up roughly 140%. Inflation was rampant. And the price of gold went up about 10 times as people fled the dollar. Now, for debtors, this was actually good in a way. They got to repay their loans with much more available and much cheaper dollars. Inflation eroded the real value of their debt. But for creditors, savers, it was terrible. They saw the value of their money just dwindle away. Dalio mentioned someone holding a 10-year treasury bond lost about 40% of their investment in real inflation-adjusted terms. This period also triggered a political reaction, didn't it? A shift towards the right, with leaders like Reagan in the U.S. and Thatcher in the U.K. coming to power, partly promising to get inflation under control. The big insight is how drastically uncontrolled money creation and inflation can redistribute wealth, usually punishing savers and rewarding borrowers.
Then the 1980s felt quite different, didn't they? Almost the opposite, like a calm before maybe the next storm.
Very different, yes. The 80s, under Volcker and then Greenspan at the Fed, were characterized by falling inflation, strong growth, and levering up. Debt started building again, but inflation was coming down. You had lower nominal interest rates, but because inflation fell faster, you actually had relatively high real interest rates. Dalio says this created ideal conditions for financial markets. It was a great decade for stocks and bonds in the U.S. and most developed countries.
Okay, fast forward a bit. We hit the new millennium, and the first big bump was the dot-com bubble bursting.
Right, that big debt asset bubble popped in March 2000. The NASDAQ, full of tech stocks, fell something like 80% from its peak. Huge losses. That, combined with the shock of the 9/11 attacks shortly after, definitely contributed to a contraction in the short-term debt cycle. A recession followed.
And then, of course, the really big one for our generation, the 2008 global financial crisis.
Yes, 2008. That was a proper big deleveraging, a major event in the long-term cycle. It started in the U.S. mortgage and real estate sector, remember subprime, which was incredibly debt-fueled. But it spread like wildfire through the interconnected financial system to banks, companies, and individuals, not just in the U.S., but globally. Unemployment in the U.S. hit 10%. Major stock markets around the world fell by more than half from their peaks. It was a brutal reminder of how fragile things can get when there's too much debt.
But then, just over a decade later, during the 2020 pandemic, we saw this massive response. Huge coordinated fiscal and monetary stimulation. What Dalio labels MP3. What exactly was that and what happened next?
MP3 monetary policy phase 3. This is where the central bank doesn't just cut rates, MP1, or buy assets, MP2 or QE, but works directly with the government to finance huge fiscal spending. Think stimulus checks, massive government support programs, all financed ultimately by the central bank creating money, and the result: a big surge in inflation, as Dalio predicted. He notes this 2020 response was the fourth and the largest big debt monetization since the original big debt monetization QE in 2008. And 2008 was itself the first time they'd done that kind of thing since way back in 1933 during the Great Depression. So these are major historic interventions. The immediate consequences were stark. Nominal treasury bond yields were pushed way down from maybe 3.7% pre-pandemic to just 0.5% at the low. Real yields, that's yield minus inflation, went deeply negative from maybe 1.4% to minus 1%. Money and credit became, as Dalio puts it, essentially free and plentiful. And what happens then? An orgy of borrowing and new bubbles forming in various assets.
And this led to something almost unbelievable. Dalio mentions a tripling of paper wealth for U.S. households. Like, financial assets went from $32 trillion in 2009 to nearly $99 trillion by mid-2024. That sounds insane. What does that mean for the average person?
It's a truly staggering number, isn't it? It really shows the sheer power of these monetary policies to inflate asset prices. For the average person, well, if you own stocks or a house, you probably felt wealthier on paper. Your 401k looked good. But Dalio's point is that a huge chunk of that wealth was a direct result of all this credit expansion and asset inflation, not necessarily underlying economic productivity or fundamental value growth. He also points to the massive growth of the private credit market during this time, essentially lending outside the traditional banking system, calling it a modern-day version of the junk bond market. This funded a lot of speculative activity and helped keep credit spreads low, further inflating the bubbles. The insight ties back to that imagined wealth idea. It can grow much, much faster than actual wealth generated by the real economy, but it's also much more fragile.
So bringing us right up to the present day, or at least Dalio's analysis timeframe of early 2025, what does he observe about those internal conflicts we discussed, especially regarding the U.S. political situation?
Yeah, he notes that the intensity increased significantly in internal conflicts within democracies, particularly in the U.S., leading up to the 2024 election. In his scenario analysis for March 2025, he describes an election where the rightist, capitalist, social conservative Donald Trump achieves a decisive win over the leftist, socialist, social liberal Kamala Harris. He interprets this hypothetical outcome as giving Trump a strong mandate for a big renovation of the central government and the country as a whole, and also to prepare for some type of war with China and his allies. Dalio clearly views this potential shift through the lens of his historical cycles, seeing parallels where periods of significant internal division and political change often coincide with rising external conflicts and challenges to the existing world order.
Okay, we've looked closely at the U.S. Let's pivot now and look at how these big cycles are manifesting in China. It's a country with its own very deep historical context. That century of humiliation really shaped the mindset of its leaders, didn't it?
Oh, profoundly. Dalio emphasizes this constantly. That period of foreign domination and internal weakness left a deep scar. It fostered this core belief among Chinese leaders that China absolutely must have the economic and military power to take care of its people and not be abused by other powers. Self-reliance and strength became paramount. And as we mentioned, Chinese leaders, according to Dalio's interpretation, tend to view the U.S. as that hegemon trying to control the world order, trying to prevent China's rise. So yeah, that historical experience is absolutely fundamental to understanding their strategic thinking today.
And right now, China is grappling with its own significant debt problems, isn't it? How's that playing out?
Yes, absolutely. China is experiencing a big debt crisis, particularly involving local governments, state-owned enterprises, and especially the real estate sector. Think Evergrande, Country Garden, those stories. A deleveraging process, trying to get that debt under control, really began back in 2021. Now, Dalio believes China technically has the ability to do one of his beautiful deleveragings. Why? Because crucially, their debts are denominated in their own currency, the yuan, and most debtors and creditors are their own citizens or state entities. That gives Beijing a lot more control and flexibility than a country borrowing heavily in, say, U.S. dollars. However, he also notes they've been surprisingly slow to deal with it decisively. He draws a direct analogy to Japan's slow response to its bubble bursting in the early 1990s, which led to their lost decades. But on the plus side, he does highlight that China still has highly competitive, innovative sectors that are not at all encumbered by debts, and he notes that currently, Chinese assets are now very cheap due to the crisis. So the key insight is, China has the tools to manage its debt relatively smoothly, but political will and timely action are crucial, and the delay carries risks similar to what Japan faced.
That comparison to Japan is really interesting. So let's dig into those lessons from Japan's lost decades. How on earth did they manage massive increases in government debt while actually reducing their interest payments? And what was the real cost for ordinary Japanese people?
Quite remarkable when you look at the numbers. Japan saw these big increases in total government debt, going from around 99% of GDP to about 215% over a couple of decades. Huge jump. But simultaneously, they achieved big declines in interest payments. The actual amount of interest the government paid to the public fell by over 50%. How? Well, two main ways. First, massive central bank purchases of government bonds. The Bank of Japan bought up huge amounts, effectively monetizing the debt. Second, average interest rates fell dramatically from around 2.3% down to just 0.6%. They basically engineered incredibly cheap borrowing costs for the government.
Okay, so they managed the government's costs brilliantly. But you said there was a real cost to the people. What was that?
Right, the cost wasn't necessarily in runaway domestic inflation or government default. Dalio points out the real cost was felt to their external purchasing power and stagnant wages. While typical Japanese worker wages stayed relatively flat in yen terms for decades, they fell significantly in dollar and world currency terms, end quote. He gives an example. The average worker's monthly wage might have gone from being equivalent to $3,500 US down to maybe $2,500 over time due to yen depreciation. Even more starkly, he translates it into gold. Maybe their earnings went from buying 13 ounces of gold a month down to just 1 ounce, a massive drop in global purchasing power. The profound implication here is that a central bank can maintain internal price stability and prevent a debt crisis, but it might come at the cost of the currency's external value and the citizens' ability to afford imports or travel. It's worth noting, though, that the Dalio adds that non-tradable essentials stayed affordable within Japan. Things like rent remained almost flat in hours of work terms. So day-to-day domestic life didn't necessarily collapse.
But he also warns there's a very large potential risk lurking on the Bank of Japan's balance sheet now. If global interest rates, and thus Japanese bond yields, were ever forced to rise significantly, the BOJ could face massive losses on all those bonds it bought, potentially reigniting the very crisis they sought to avoid. So the strategy isn't without future dangers.
So many complex layers and trade-offs in these cycles. Okay, let's bring it back to the immediate situation. Dalio's risk assessment as of March 2025. What's his take on U.S. debt risk right now?
Okay, his assessment then was nuanced. He judged the long-term risks of U.S. government debt to be very high. Why? Because debt levels and, crucially, debt service levels, interest payments as a share of income, were at the highest ever, and seemingly nearing that point of no return we discussed. However, he also said that currently there's a very low imminent risk of a crisis happening right away. This was because at that moment, inflation and growth were moderate, credit spreads, the extra interest risky borrowers pay, were low, and the U.S. private sector was generally in pretty good financial shape. He stresses that the U.S. dollar's status as the dominant world reserve currency is a great risk mitigator. It gives the U.S. unique borrowing privileges, but he also observes that the U.S. is actively undermining this status through various actions like weaponizing the dollar or running huge deficits, so that key mitigator might not be as strong in the future.
And what about Japan and China's debt risks in his view?
For both, he basically reiterates that while they have very large Japan or relatively big China debts, the risk is significantly mitigated because the debt is overwhelmingly denominated in their own currencies, yen and yuan. This gives their governments and central banks far more control over managing the situation compared to, say, an emerging market country that borrowed heavily in U.S. dollars and now faces a currency collapse, making that debt impossible to repay.
Okay, so given these massive debt challenges, particularly in the U.S. long term, what does Dalio actually propose? He seems pretty critical of how policymakers usually handle this stuff.
He is quite critical, yes. He thinks they often get bogged down arguing about the particulars. Should we cut this program or raise that tax, instead of focusing on the big picture, the top-down goal, which should be stabilizing the debt relative to income. So he proposes a kind of fallback plan. First, policymakers should agree on a necessary total amount of deficit reduction needed to stabilize the debt trajectory. Let's say, for example, a cut equal to 3% of GDP is needed, or maybe over 4% if recent tax cuts are extended, he calculates. Then they try to agree on specific cuts and tax hikes to reach that target. But if they can't agree, which, let's face it, is common, then an automatic fallback mechanism kicks in. This fallback would impose equal percentage cuts to all spending that can be cut and equal percentage increases on all taxes that can be increased across the board until the target is met. The core idea is to force action, to have a mechanism for fiscal responsibility even when the political will is lacking.
Equal cuts and tax hikes across the board. That sounds potentially painful, too. Are cuts of that magnitude, like 3 or 4% of GDP, actually manageable historically, or would that crash the economy?
Dalio argues they are very manageable by historical standards. He points to the U.S. experience between 1993 and 1998, during the Clinton administration, where deficit reduction efforts led to an improvement of about 5% of GDP in the budget balance, and the economy did quite well. He also sketches out a potential 3% three-part solution, where the needed adjustment, say 3% of GDP, is spread roughly equally across spending cuts, tax increases, and perhaps some benefit from lower interest rates if the plan restores confidence. However, he's not naive about the challenges. He acknowledges that something like 70% of U.S. federal non-interest spending is mandatory, things like Social Security, Medicare, veterans benefits, which are politically incredibly difficult to cut. And he stresses the importance of considering the second-order consequences of any cuts. Cutting a school lunch program, for example, might save money directly, but have significant negative impacts on children's health and education down the line. So yes, it's manageable on paper, but the political and social complexities are immense. It requires careful balancing.
Wow, what an incredibly comprehensive deep dive into Dalio's whole framework. It really does provide a powerful lens, doesn't it? A way to understand these huge, interconnected big cycles and make sense of everything from financial crises to political turmoil and even tech disruptions.
It really does. It's a challenging perspective, but it offers a kind of map for navigating what often feels like chaotic times. And Dalio leaves us with one final, really provocative thought that kind of ties all five forces together. He acknowledges these incredible technological advances we're seeing, especially with AI, but he ultimately believes that this positive force will not be enough to negate the headwinds of debt, internal conflict, external conflict, climate change, and demographics.
So even AI isn't enough on its own. What is the ultimate deciding factor then? What's the key takeaway for us, for the listeners, trying to make sense of this grand unfolding picture?
Well, he argues that the factor that outweighs everything else, the biggest, most important force, is simply how people deal with each other. If we as individuals, as communities, as nations, can figure out how to address our shared problems and opportunities constructively, focusing on cooperation, aiming for the best outcomes for everyone without trying to damage each other, then we stand a much, much better chance of navigating these massive, inevitable cycles towards a more stable and prosperous future. It's a powerful challenge for all of us, really. It suggests that at the end of the day, even the most complex economic and geopolitical forces hinge on something very basic: human behavior and our collective capacity for wisdom and cooperation.